On August 12, 2021, Wish.com announced a $1.1 billion cut to its advertising budget. Within 4 months, the stock was down 90%. Then a Chinese company called Temu copied the exact same model, kept spending, and became the most downloaded shopping app in America in 5 weeks. CEO Peter Szulczewski had said, "We plan to slowly ramp up our growth advertising investments." But the ramp never came. By 2024, Wish sold for $173 million, 1% of its peak. This is the story of how an $18 billion company died from a textbook correct decision, killed itself with discipline, and handed the largest e-commerce growth story of the decade to its competitor. To understand how fast Wish fell, you need to understand how high it climbed. Wish was founded in 2010 by a former Google engineer named Peter Szulczewski, who had spent 4 years writing keyword expansion algorithms inside Google's ad machine. 3 years later, that algorithmic instinct shaped his next company. Wish was a mobile-first marketplace selling ultra-cheap goods direct from Chinese factories, served to users not through a search bar, but through an algorithmic feed that learned what each user wanted to buy. The model worked. By 2018, Wish was the most downloaded shopping app in the world. By 2019, it was the third largest e-commerce marketplace in the United States, with annual revenue of $1.9 billion. That year, a Series H led by General Atlantic priced the company at $11.2 billion. In December 2020, ContextLogic, Wish's parent company, went public on the NASDAQ under the ticker Wish. The IPO priced at $24 a share and raised $1.1 billion. Within weeks, the stock climbed past $30 and the market cap peaked above $18 billion. Annual revenue hit $2.5 billion, more than triple what Wish had reported 4 years earlier. The pandemic had pushed shoppers online. Wish had captured them by the tens of millions. By early 2021, Szulczewski sat on top of one of the largest e-commerce platforms in the West. The shopping app had been the most downloaded in its category for 3 consecutive years. The model looked unstoppable. Then it started to break. By spring 2021, Wish was already under pressure. Counterfeit listings had drawn complaints for years: knockoff electronics, fake brand name watches, items that bore little resemblance to the photos. Trustpilot reviews skewed brutal on quality, shipping times, and customer service. App installs in Q2 2021 fell 13% globally as pandemic shopping behavior unwound. These were chronic problems Wish had survived before. Then Apple flipped a switch. In April 2021, Apple rolled out app tracking transparency on iOS. Every app now had to ask users for permission to track them across other apps and websites. Most users said no. Almost overnight, the data signal that powered targeted advertising on iOS collapsed. Advertisers shifted spend toward Android, the platform where most of Wish's users actually shopped. Bidding competition exploded. The cost of acquiring a single new Wish user climbed sharply, while the conversion rate on each acquired user fell. Wish's entire business was a customer acquisition machine. Buy a user on Facebook or Google for less than the lifetime value of their orders. Feed them through the algorithm. Repeat. When acquisition costs rose and lifetime value fell at the same time, the math behind the machine flipped negative. By August 2021, Szulczewski had to decide what to do about it. The decision he made would arrive on a single phone call. On August 12, 2021, Peter Szulczewski sat down for a conference call that would mark the inflection point of his company. The Q2 numbers were bad. Revenue down 6% year-over-year to $656 million, the first decline in Wish's history as a public company. But the number wasn't what broke the stock. The strategy was. Szulczewski announced that Wish was significantly cutting back its digital advertising spend. The internal logic was defensible. Wish's data science algorithms were designed to optimize the return on every advertising dollar in real time, bidding for users only when projected lifetime value justified the cost. As iOS privacy changes pushed acquisition costs up, those algorithms had begun pulling spend down automatically. Continuing to spend at 2020 levels would have meant buying users at a loss. The textbook response was to retrench, focus on retention, and wait for the unit economics to stabilize. Once we see improved user engagement trends, Szulczewski told investors, We plan to slowly ramp up our growth advertising investments to reignite our new user acquisition engine. Translation: we'll stop buying customers until customers want to come back on their own. The market understood the implication immediately. Within 48 hours, Wish's stock had fallen 27%. On paper, the call was the disciplined response. In practice, it was the moment Wish stopped feeding the only thing that made Wish work. By the end of 2021, Wish traded below $3 a share, down more than 90% from its post-IPO peak. The market was no longer pricing Wish as a growth story. It was pricing whether the company could survive at all. The user base began to evacuate. The ramp-up szulczewski had promised never came. The data science algorithms designed to optimize returns on marketing investment had no users left to optimize for. The system built to maximize the value of each acquired user could not function in a business that had stopped acquiring users. The leadership churn was as severe as the financial collapse. 3 months after the August call, szulczewski stepped down. His replacement lasted 7 months before being fired. The third CEO arrived in September 2022. 3 CEOs in 18 months. None of them could change the underlying math. Zhou Yin, the third CEO, tried everything. A merchant quality program, a TikTok-style video shopping product called Wish Clips, the wind down of unprofitable first-party retail and wholesale operations. None of it moved the needle on user count or revenue. By November 2023, ContextLogic was exploring strategic alternatives. Negative cash flow had reached $86 million in a single quarter. On February 12, 2024, ContextLogic agreed to sell substantially all of Wish's operating assets to Qoo10, a Singaporean marketplace operator, for approximately $173 million in cash. The shopping app that had been the most downloaded in the world for 3 consecutive years had just sold for less than 1% of its peak market cap. The question that hung over the entire collapse was simple. Was the demand actually gone? Or had Wish just stopped paying for it? The answer arrived from China, while Wish's CEOs were still rotating through the door. In September 2022, just 1 month before Wish's second CEO got fired, a Chinese company called Temu launched a US marketplace. The model was almost identical to Wish's. Cheap goods direct from Chinese factories. Algorithmic discovery feed. Long shipping times. Aggressive paid advertising as the primary acquisition channel. The only difference was posture. Where Wish had cut ad spend, Temu accelerated it. By October 17, 2022, 5 weeks after launch, Temu was the most downloaded shopping app in America. In 2023, Temu paid $7 million for 30 seconds of Super Bowl advertising, ran the spot twice, and gave away $10 million in prizes during the broadcast. The next year, Temu doubled the giveaway to $15 million. PDD Holdings, Temu's parent company, drove tens of billions of dollars in advertising into Meta's ecosystem alone. By December 2024, Temu's monthly active app users globally had surpassed Amazon's, according to Sensor Tower. Shine followed the same playbook in fast fashion. By 2024, both apps sat consistently in the top 2 shopping apps in America. Etsy's CEO told investors in 2023 that Temu and Shine were almost single-handedly impacting the cost of advertising on Google and Meta. They were doing it with the same product Wish had pioneered, in the same channels Wish had abandoned. Temu was reportedly losing money on individual orders to fund the user acquisition push. Wish had decided that exact strategy was no longer rational 18 months earlier. The market Wish had created, Western consumers willing to wait weeks for ultra-cheap factory-direct goods, was not shrinking. It was the largest e-commerce growth story of the decade. Wish had simply stopped paying to participate in it. By the time Qoo10 closed the acquisition in April 2024, Wish had fallen from the 3rd largest e-commerce platform in America to roughly the 35th most popular shopping app. The shopping app that had been the most downloaded in the world for 3 consecutive years was now a footnote in the category it had created. The collapse of Wish was not a story about a bad product, a regulatory crackdown, or an unsolvable shift in consumer behavior. The product still works. Qoo10 paid $173 million for the platform, and Temu and Shine are now scaled versions of the same model. The collapse came down to 3 mistakes. First, Wish confused marketing efficiency with marketing necessity. The data science algorithms were designed to optimize the return on each advertising dollar. When iOS privacy changes pushed costs up, the algorithms responded the way they were built to respond. They pulled spend down. The problem is that algorithms can optimize the cost of acquiring a user. They cannot decide whether the business should be acquiring users at all. Wish treated its $1 billion ad budget as a variable cost to be minimized when efficiency declined. Temu treated the same kind of spend as the price of admission and accepted unit losses to keep buying users. In a marketplace built on paid acquisition, ad spend is not a discretionary line item. It is the business. Second, when the moat is rented, there is no moat. Wish's competitive advantage was never the algorithm or the merchant network in isolation. It was the constant flow of paid customer acquisition that fed the algorithm fresh data and gave merchants reasons to list. The moment ads stopped, two things happened simultaneously. New user data dried up, which degraded the algorithm, and merchants saw order volume collapse, which reduced selection, which gave existing users fewer reasons to return. The flywheel ran in reverse at the same speed it had run forward. Compare this to Amazon, whose moat is its logistics network and Prime membership base, assets it owns. Wish's moat was the rented attention of 1 billion users on Facebook and Google. Renters do not own the building. Third, quality problems compound when growth stops. As long as new users kept arriving, the customers who received counterfeit watches, fake brand name electronics, or items that never shipped were a manageable minority. The growth covered the noise. Once acquisition slowed, the existing base aged out, and the brand's reputation for counterfeits, slow shipping, and weak customer service became the dominant signal. Temu and Shein arrived in the same market with the same low prices and most of the same complaints, but without a decade of public reputation damage. They got to start clean. Wish did not. Quality debt is invisible during growth and crushing during contraction. Wish had spent a decade buying customers $1 billion at a time. The day it stopped paying, the customers were no longer Wish's. They were just available, and Temu was paying.